Good morning, everybody. I should say that anything I say relates to my own opinion and doesn't necessarily represent the views of the Central Bank of Ireland. In fact, most likely don't represent the views of the Central Bank of Ireland. I hope the turnout this morning is more reflective of the weather outside rather than the panellists. We'll see. I don't intend to speak for too long. I'd rather that we get into a conversation, and I know Hugh is anxious that we do that too. So I was asked to talk about the big picture, so I decided I'd start with pictures and maybe even stick with pictures to try and understand why we are where we are, what we're doing about it. Are we doing the right things? Are we having an impact on financial services that we're not aware of, that we haven't prepared for, that is unforeseen? And really, are we focusing in the right areas? So how did we get to where we are? I mean, was it just a case the financial services industry ran riot? Yes. But I think the reason the car crashed, it wasn't because of the financial services industry, it was because supervisors were asleep at the wheel. And by supervisors, I include myself, central banks, financial regulators, not only in Europe, but across the globe. And we too got caught up in that mad party that we all went through up to 2007. Was it insufficient regulation that got us there? Well, we had Basel II, MiFID II, UCITS 1, 2, 3, 4 and 5. You know, all those regulations came in really driven by what the financial services industry was looking for. I know I myself was involved in the Basel II negotiations, and they were driven almost entirely by industry in terms of the changes to capital requirements and so forth. We had a whole lot of regulation that was taking place all through the end of the 90s into the early 2000s, that was all of which were going to introduce a new, more risk-focused regulatory regime that was more focused on the risks that institutions were actually facing, and that better represented those risks and how they took on those risks and measured those risks. So you have to wonder, was it something else? And the reality is we are absolutely tied up totally and utterly in regulation and the amount of regulation that we have. As I said, a lot of this regulation was demanded by industry, but equally too, a lot of it was demanded by supervisors, central banks and regulators. And I mentioned Basel II and MiFID and so forth. The reality is now we're moving on to Basel III, CRD IV, Solvency II, MiFID II, MAD, MAR. I could go on and on. I recall when I was involved in one of the major Irish presidencies back in the 90s, 1996, we had about 10 financial services directives on the go at the time, and it was a significant challenge to actually get those through the negotiations. Coming into our presidency next January, there are actually already 27 financial services directives being negotiated, or not being negotiated as the case may be, but certainly tabled. So the question arises, will regulations ever match what is happening in the financial services industry? Will regulation ever match innovation in the financial services industry? And I use the word innovation loosely. If you think about it, under Basel II, we decided that we'd recognise securitisations and how securitisations were beneficial, how they did reduce risk and so forth. But, you know, the ink wasn't dry on a recognition of securitisations, and suddenly we had synthetic securitisations. Credit default swaps, which were proper hedges involved in people and different on both sides of a deal, suddenly became punts for other people in the market. You know, so financial innovation will always move ahead of regulation, and I would suggest financial regulation will move always ahead of business generally. So, for example, there was a significant case taken by the Commission against some cartels in Europe 2 days ago. Big talk about tax avoidance in terms of Google, Apple, Microsoft, Amazon, Starbucks in the UK. This was, by the way, there's nothing wrong with tax avoidance, and I worked in the Chief Inspector of Taxes for 13 years. Tax avoidance is good. If there's something wrong and tax avoidance is wrong, but then you change the rules. Significant difference between that and tax evasion. But I think my point is, when you look at all of those things changing, that industry and practitioners move a lot more quickly than regulators do. And then it comes down to supervision. Can we ever expect supervisors to supervise all of these institutions properly? The reality is no, there's no such thing as a no failures regime. And even if one were to focus solely on the higher impact institutions, because of interconnectedness in the markets, you will find that in fact you're not focusing on the right institutions at all. So in my own jurisdiction, it wasn't one of the systemically important banks that caused major problems. Equally in Spain, if you look at the CAIAs, they wouldn't have been high impact banks at all and therefore wouldn't have been subject to any significant level of supervision and therefore would not have been captured. But now we have the financial services industry complaining about the volume of regulation and it's not actually achieving anything. But in fact, it was the financial services industry who asked for this regulation in the first place. And part of the problem there is that are the new regulations up to the task? And the answer to that is we don't know yet. And I don't think we will know. And we're introducing regulations at a time when an awful lot of jurisdictions are going through austerity, when there's little or no growth, we're at the bottom of the market, there's no lending taking place, and there are differences of opinion as to what the impact of that regulation will be. So, for example, you have the Institute of International Finance saying that the new regulations could add anything up to 56 basis points to lending rates in the future, whereas other institutions are saying it's as low as 18% in Europe anyway, perhaps slightly higher in the US, but lower again in Japan. On the other hand, you look at the World Economic Forum and their report, and more likely, with a higher impact, and in fact the highest impact of all the likelihood in their Global Risk Report 2012, is a major financial systemic failure. Unintended consequences of regulation, very low in impact and much lower in likelihood as well. So I think, again, it's hard to know whether the regulations are right, if they're working, but the likelihood of them having a negative impact, I think, is quite low. You see perhaps what's happening in Solvency II, which we're actually negotiating since 2003, but the insurance industry woke up only 12 months ago to realise that long-term guarantees were going to be significantly affected by the new proposals, and how that was going to affect their business. But it did take them quite a while to wake up. It took some supervisors quite a while to wake up as well, so it's not only the financial service industry who are to blame. But one of the things about that regulation is it has the potential to shift the insurance model. Not unlike IAS 39, the fair value standard shifted models in financial institutions in terms of how they do their business, and to me that's not necessarily a good thing. Will regulation change the way financial services behave? Not really, I don't think so. The reality is financial services are there to make money, they're there to take risk, and very rarely have a long view. And I think that's something that we really do have to change, and I think that's where the regulation has to focus. I'm coming up very quickly on my 10 minutes. Sorry, you moved faster than I thought. But the reality is a company called Protiviti did a survey at the end of 2010 asking financial services industry participants what their view of regulation was, and 97% of them were pessimistic, and that was across the US and the UK, about the measures taken in financial services. But nevertheless, again, just short of 60% said the cost of compliance with the new regulations would be less than 5%. So again, industry viewed the regulations differently to the way I think the general public, politicians and supervisors view them, because the industry tends to move on. Are we focusing on the right areas in regulation? And here I would like to hear your thoughts, because frankly I think we're not. I think what's wrong in the financial services industry is the culture of the financial services industry. We are doing nothing on a European or a global level to introduce proper corporate governance rules, and I mean rules. I think my own jurisdiction is the only jurisdiction that have legal requirements for banks and insurers on corporate governance. And I think until such times as we have a robust legal framework on corporate governance, we will not change the culture. We have to get the financial service industry back into taking a long view, back into taking lower risks, back into having socially useful products, if I can use the expression used by Hector Sanson, Adair Turner, and really to look again at what their practices are, how they remunerate their employees and so forth. And just on one final point, people who have got away with blue bloody murder, in my view, in the financial crisis are the auditors. And that is something else that we're not addressing at a legal level. There's talk about the proposal for auditor rotation and so forth. That's not really what the problem is at all. I went through the bank audits of a wide range of banks throughout Spain, Ireland, the UK, and there wasn't one single qualified opinion given throughout the crisis or before. There wasn't even one single emphasis of matter opinion given throughout the crisis, when everybody could see what was happening in property markets and so forth. So I think one thing that we do have to address is auditors, and in particular the audit opinion and what it represents. Thank you, Hugh.